Out of the auto show. Jose
Thank
Munoz.
you for having me.
A lot more on the auto sector is still coming up this hour. The CEO of Mercedes USA will join us to discuss his company's plans to catch up to its luxury rivals.
Plus, shares of McCormick jumping this morning. The company, which makes spices, beating estimates on the top and bottom lines. Higher prices, a driver, driving 3% gain in revenues. One area of concern for the company was China, with management saying they expect a number of products to be impacted by slower demand there in the first half of the year. We're back in just a moment.
Female CEOs are about 10% of CEOs. And in the startup space, we actually get less than 2% of dollars from VC funding. And we have to celebrate women. Women tend to actually be more behind the scenes. We prefer to focus on building companies than to be in the spotlight. But little girls won't be able to know that they can become CEOs and founders and executives and anything else that they want to be unless they see us and they see what they could become.
Of income.
Couple hours into trading, another tight range today. Let's get post to post with Bob Pisani. Hey, Bob.
So a lot of interest suddenly in the capital markets. We got IPOs moving. We've got SPACs moving. Is the capital markets opening up? Maybe, but it's kind of exciting to finally see people buying some new stuff out there. So we've been covering, of course, what's going on in the NASDAQ, Trump Media and Technology. starting today. On the NASDAQ here, this is the merger between Mr. Trump's company and the Shell company, Digital World Acquisition. On the NASDAQ, DJT is the symbol. Almost 30 million shares traded so far today. That's a very healthy start, and it's up more than 30%. You see they're fairly steady throughout the afternoon. Now, so a lot of people are messaging me, okay, Bob, does this mean the SPAC market is coming? Because this was a SPAC. I don't think so. This is a very particular situation here, but I am pretty excited about what I'm seeing in the IPO market, because look at this. Reddit. Now, here is a pleasant surprise. It goes public at 34, what, 4 days ago, 5 days ago? Here, it doubled. It's doubled. Do you know how unusual that is? And it's doubled on very enthusiastic volume. And I think this is good news for the IPO markets. Now, are you asking me why exactly has it doubled? You can argue a lot of pent-up demand out there. I'm frankly surprised by the whole thing, but here's why I'm happy. Most of you viewers write to me and say, oh, we bought into the XYZ IPO on day one, and 4 days later, it's down. We're losing money. Thanks very much, Bob. Well, here's the exact opposite. 4 or 5 days later, your money has doubled. This is great news. It's very good for the investors, very good for investor sentiment to see an IPO trading up 4 or 5 days later. That's why I'm happy about this. Then there's the other big one, Astra Labs. Now, this is on the NASDAQ. You know, this happened 4 or 5 days ago, and what went on there? They were what, 36? It hit 95 today. Now, it's come down a little. Somebody's taken some profits, understandably, so it's around 81. But this was an obvious AI home run. They make the chips that make servers operate more efficiently. I called this weeks ago. This obviously big AI play, no-brainer here. So you got 2 IPOs that are really doing well. One's sort of a plain vanilla, you know, social media company, and the other's a home run AI company, both doing really well. This is a positive signal for the IPO market. So you got some average stuff floating around there, like Del Monte, the canned fruit maker, that's been floating around. They'll like what they see here. Panera Bread's been floating around for a long time. They'll like seeing this. Service Titan, they provide software for residential commercial building. Sarah, these average companies that are out there, they're not tech titans out there, all are going to watch Reddit and say, okay, now we're interesting. Call the lawyers and start moving. So that's why I'm happy, and the viewers are making money. Sarah?
Is it retail buying? Is it that kind of retail enthusiasm?
I don't know. You know what was going on, how unusual the structure was, because they allocated a lot of money to the people who were running the message boards and the people who were owners of essentially managing the message boards there. And that may be a factor here, but even with that, you know, there wasn't a lot. They're not making money still. So I don't want to pick on this. I'm just happy that it's doing it, and I don't know why. It may be the individuals and the way they gave out the IPO. It may just be the pent-up demand. There still hasn't been a lot of them out there. I'm just happy it's doing well. And I'm happy to say that I was wrong on this one. I'm happy to say people are making money. That just makes more IPOs is what we want. We don't want public companies sitting and getting old, hiding in the private markets. We want the viewers coming out and getting interested in new companies, not old companies.
We're happy if you're happy. Also, Larry Fink talked a lot in his shareholder letter today about the importance of a strong capital market and why everybody's attracted to the U.S. This plays in. Thanks, Bob.
All right.
Bob Assani. Time now for a news update. Bertha Coombs has it for us. Hi, Bertha.
Hi, Sarah. Independent presidential candidate Robert F. Kennedy Jr. is expected to announce a running mate today. Sources tell NBC News attorney, entrepreneur, and philanthropist Nicole Shanahan will join him on the ticket. Like Kennedy, Shanahan has never run for elected office, but she has contributed heavily to his campaign and super PAC. The official announcement is expected later today. Texas Attorney General Ken Paxton agreed to pay nearly $300,000 in restitution today. The payment is part of a deal that ends criminal securities fraud charges against him that have followed him since he took office nearly 10 years ago. Prosecutors announced the deal today, just weeks before Paxton was supposed to stand trial. And NFL games will look a little different next season at the start. Team owners voted today to approve a new kickoff model that aims to make the historically dangerous play safer. Most of the players will be moved downfield from the kicker in an effort to minimize collisions. The update marks one of the most significant changes to on-field rules in decades. They are changing things up on the NFL these days. It's going to look weird, I think.
There have been a couple changes this week, Bertha. Absolutely. Thank you, Bertha Coombs. Coming up after the break, why emerging markets might be a more attractive asset class than developed markets into the second half of the year.
And we are watching UPS losing its early morning gains as Investor Day wraps up. Analysts saying that the company's 2026 target may be too ambitious. It's now on pace for its worst day since its earnings report back in January, down almost 4%. Money Movers will be right back. The S&P and NASDAQ less than 1% from all-time highs. Despite the recent bull run, though, for U.S. equities, quant fund AQR Capital Management doubling down on its call to bet on emerging markets, with 8 of its $103 billion of assets under management invested in an emerging markets equities portfolio. With us now is Dan Villalon, principal and global co-head of the Portfolio Solutions Group at AQR Capital Management. It's good to see you, Dan.
Great to be here.
I highlight the EM view because it's kind of, well, it's definitely not consensus right now. All the actions in the U.S. or Japan or the German DAX at a record high. Why does EM look like a better bet?
Yeah, I will be the first to admit EM is hard to love if not for valuations. Why do valuations matter? Well, because valuations are one of the few tools that investors have to predict not next year returns, but 5 to 10 year returns. So from a 5 to 10 year perspective, if you look around the world, look at all these regions, look at all these countries, well, the ones that are most expensive are the ones that have performed the best lately, the US. Where do we see value? Well, in emerging markets. And so that's kind of headline one for why do we think emerging is posed to outperform. It's really a valuation story.
So this is the value, I mean, Cliff has been on over the years talking about the value dislocation in the US market. You see it now moving to emerging markets.
And I'm glad you Cliff, when Cliff talks about value and emerging, he's actually making value do double duty. So job number one is emerging markets as a region are cheaper than developed and certainly cheaper than US markets. The second duty that Cliff is employing on value is within. When you look kind of within an emerging market, within a country, and compare cheap stocks versus expensive stocks, there's a dislocation there, the likes of which we have rarely seen in history. Put simply, cheap stocks are just much cheaper than their counterparts. We're still in the top decile of what we've seen, and that's sort of a particularly attractive proposition, particularly for active managers.
What's a good example of that, where the nesting doll effect is really interesting?
Yeah, so one of the interesting things, if you think about sort of a rubber band between cheap and expensive stocks, the best historical example we have is the tech bubble. There you found that tech stocks became way more expensive than basically everything else. One of the interesting things today, one of the reasons today is so unique for value-oriented investors is because it's not just a tech bubble, it's really an everything bubble. You look within individual sectors, within individual countries, within regions, and you find this rubber band is stretched kind of everywhere. And so this is an additional benefit that we find particularly attractive in emerging, but also in US, also in international development.
What's client interest like right now in EM? Do people want to hear about it? Or are they too busy focusing on what's working?
I feel like this is a leading question. You're right. They are not focused on it. One of the reasons that we've been, I wouldn't say shouting from the hilltops. We don't usually take huge tactical bets, but one of the reasons we've been pretty public about our relatively bullish view on EM is because so many investors have ditched the asset class. I think because of trailing performance, they say, it's not really worth the risk. I'm going to stick with the thing that's worked. Unfortunately, investing is all about looking forward. Over the next 5 to 10 years for the region, and even shorter term for active management, we think that there's a great case to be made. Investors, we don't think that they need to make a massive overweight, but at least do something about the underweights that they've made, either implicitly or explicitly. It's time to get back in, we think.
Does it matter which emerging market?
Not for us. One of the big things at AQR, if you ever walk our hallways, you're probably going to hear the word diversification more than you would ever choose to. And that's how we approach it. When we look at the markets, we're not looking at individual securities or individual countries so much as the whole. Now, one of your questions might be with regard to China, right? I mean, I think this is, I guess I can't really use the elephant in the room. I need sort of a better analogy here. But one of the nice things is we find that the case for emerging does not hinge on China. If you were to invest in emerging markets with or without China, we find that the case is equally strong. Expected returns are
Well, is China
attractive.
part of your investment case?
Well, it's part of it. So, China is 26% of the emerging markets by market cap. So it's kind of a weird thing to exclude, but I get it. There are some investors who have made that choice. The good news for them is it doesn't really matter. It's about as equally attractive as the other emerging markets. So whether or not it's in there, we don't think that's going to impact expected returns or what you should expect for investing in the asset class.
Interesting case, Dan. Thank you for coming on to talk about it.
Thanks for having me.
Really appreciate it. Dan Villalon of AQR Capital Management. When we come back, Adam Newman making a $500 million bid to buy back WeWork. But how's he planning to finance the acquisition? We've got more details for you on this after the break. More new drama in the saga of WeWork. This time, former CEO Adam Neumann submitting an offer to buy the now bankrupt co-working company for more than $500 million. Deirdre Bosa has details in today's Tech Check. We're going to need some sequels on all those series and documentaries.
Yeah, this is like the series that doesn't end. So Neumann, yes, he is still trying to buy back WeWork, but let me just say this is far from a done deal. For starters, financing is still unclear. A spokesperson from Flow, that is Neumann's current startup, says that 2 weeks ago, a coalition of half a dozen financing partners submitted a potential bid, potential being the key word here, meaning conditional. A source tells me that WeWork has not opened up their books to Neumann, and until they do, a deal cannot move forward. But there is a decent amount of information about WeWork that is public. Its latest 8K filing shows $10.8 billion in assets, $9.8 billion in liabilities. In January, the company brought in about $90 million in revenue and lost $150 million. Bottom line, this is a company that's still struggling and bleeding cash. To buy the company out of bankruptcy, a source tells CNBC that Neumann's bid could go up to $900 million, raising the question, where does that money come from and who are those dozen financing partners? Neumann nor Flow are willing to say, and I can rule out Dan Loeb's third point, who was mentioned in a letter last month as a potential partner. But there's one big name that has given money to Neumann post-WeWork implosion, and that is Silicon Valley VC Andreessen Horowitz. In the largest individual check the firm has ever written in a round of funding to any company, it invested about $350 million at a $1 billion valuation back in mid-2022. Some in the industry, they saw this as a way of Andreessen backing the so-called cult of the founder, an ethos here that is still very much alive. On one hand, you have a Sam Altman, who could not be ousted from OpenAI. On the other hand, you have Sam Bankman-Fried, who is due to be sentenced on Thursday for fraud at FTX. It's this idea in Silicon Valley that disruption needs larger-than-life founders, and the line between succeeding wildly and failing spectacularly, that can be thin in this world. In the case of Neumann, it looks like the jury is still out. In a blog post at the time of that funding, Mark Andreessen wrote that Adam Neumann and the story of WeWork have been exhaustively chronicled, analyzed, and fictionalized, sometimes accurately. But he says that Adam remains, quote, a visionary leader who revolutionized the second largest asset class in the world, commercial real estate. And for Adam, Andreessen goes on, the successes and the lessons are plenty. In other words, a key part of that founder's ethos in Silicon Valley. Fail fast and fail often. Still very much alive here, guys.
Fascinating story, Dee. We'll watch it with your help. That's Deirdre Bosa. Coming up after the break, the CEO of Mercedes USA joins us. He'll break down the company's plans to catch up to some of their luxury rivals and growth expectations for its EV lineup in a minute. Welcome back. As we get ready for the big New York Auto Show, our Phil LeBeau joins us with the CEO of Mercedes-Benz USA. Morning, Phil.
Good morning, Carl. Dimitri Salakis, thank you for joining us here at the Automotive Forum for J.D. Power, NADA. Quick question. Baltimore is a huge port for the import of vehicles for Mercedes-Benz from Europe. How much of an impact will this bridge collapse have in terms of the vehicles you're bringing in?
Phil, that was a very sad story which deployed over this morning. And first of all, our thoughts and prayers go with the families of the people which are missing. On the good side, we don't have unaccounted people out of our team down in Baltimore. And coming to your question, Baltimore is one of the actually 4 distribution centers that we have in the US, and definitely a port of entrance for vehicles which are produced in Germany. But we do have a couple of other places like Brunswick, which would help us.
But there is a concern about the lack of capacity for the industry overall on the East Coast, and now you're basically cutting off the main place for bringing in vehicles, right?
Yes, it's too early to see the effects. The situation is still developing, and we'll do our best to make sure that we find ways to supply the vehicles out in the market. But it's still too early to judge.
When you look at the market overall right now, first quarter sales for the industry, best since before the chip crisis. Where is the growth coming from in terms of greater sales right now?
You said it quite right. It's the year where we have more supply in the market. We have new models which are coming in the market. So customers are feeling compelled to go out and buy the products which you have in our stores. So on our end, we're launching this year 25 new products. Already 3 of them are in the market since February, and we see quite an uptick in our demands.
And some of those are EVs, but you don't have any EVs right now that qualify for the federal tax credit. Is that hurting your ability to attract buyers when it comes to going electric?
We have our products are qualifying for the lease credit. So for
the lease credits,
for customers which are leasing their vehicles, they do have the full benefit. But at the same time, we try to be competitive in the market, so have compelling offers not only of products but also finance offers and leasing offers in the market, which are quite attractive.
Are you seeing as much demand as you expected when it comes to going electric?
It's a growing demand. I would say the adoption rate is not as high as initially expected from all of us, but we have a good portion in the market. 15% of our retail sales in 2023 were electric vehicles, and we see this year also the demand being there. New products are being launched. The G-Class is becoming electric in the next month, so we are moving in this area.
Last time we talked in Atlanta, at your headquarters, you were opening up a dedicated charging station, the first of many you plan to open up around the country. How quickly will you be able to open up those dedicated Mercedes charging locations?
So our plan is to open. Last week I was traveling to Florida, and I could charge my vehicle on the way to Florida 2 times on Mercedes-Benz chargers. So the network is growing fast enough in locations where our customers are driving, are using their vehicles.
Are you finding that still remains one of the main drawbacks, if you will, to people going electric? Concerns about longer-term drives, being able to recharge?
Yes, customers are concerned about what we call range anxiety, right? Which on one hand, we develop vehicles which offer faster charging times and longer range, but at the same time, more charging stations are coming on the way.
And it's the faster charging that's the key component here.
Absolutely, absolutely. We talk about 400-volt chargers, which can charge your vehicle in 15 minutes. So this is where we're moving that.
Dimitri Salakis, who is the CEO of Mercedes-Benz USA. Guys, we've been talking about the Baltimore port. That is the largest port of entry for bringing in vehicles, not just from Europe, but also from Asia. So it will have huge implications. They're going to have to reroute not just for Mercedes, but the industry overall over the weeks to come. Guys, back to you.
Good stuff, Phil. An important story related to the auto industry. We already heard from the Ford CFO today saying they're trying to maybe reroute some of their incoming shipments of autos.
Yeah, I mean, that's going to be one of the economic fallouts that we're going to watch here of this terrible incident. In the meantime, just watching the market, Carl, steadily higher. Most sectors on the S&P are up. The Dow is rising another 116 points. To your point, though, not a whole lot of action beyond that. It's just kind of staying at these high levels. Unless you're watching some of these new entrants. How about DJT? The Trump SPAC, it is now trading. This is the parent company of Truth Social, and it continues to soar, up 34%, giving President Trump a lot of paper gains.
Yeah, and Reddit, of course, Bob Pisani's been talking about that. Big focus for Cramer this morning, just these new issues coming to market through different ways, but nonetheless driving a lot of interest.
And the question is, how much of it is retail interest? Is meme trading back? I will be watching GameStop. It reports after the bell today.
Yep.
A long-time retail favorite and meme trade favorite. So it's certainly interesting. And we still got some other earnings coming this week.
Tomorrow we'll get Carnival, RH, and Waller too, right?
And
in
Waller,
the evening.
Yes, always a news-making headliner when it comes to the Fed. Although it feels like those Fed comments are being absorbed less by the markets after Powell sent his message that he was cool with the market pricing 3 cuts.
Let's get to Post 9 and the judge.
Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner. The state of the tech trade, that's front and center. That sector hitting a new record high today. 2 committee members making big moves in that space as well. We debate the road ahead for one of the quarter's best performing sectors. Joining me for the hour today, Stephanie Link, Jason Snipe, and Jim Blaventhal. Good to see everybody here at Post 9. Check the markets. We are green, as Sarah was saying, across the board. Nas on pace for its 6th positive day in 7. I said the tech sector hitting a record high today, apropos to our conversation, because 2 people to my left have made some new significant moves in this space, and that's where we're going to begin today. Jason, I'm going to start with you. You bought Apple. You bought more Apple. This stock has been a dramatic underperformer. Month to date, it's the only one that's negative out of the mega caps. Right. It's down 5.5%. Quarter to date, it is the only one of the mega caps that is negative, down 11.5% on the year. Why was now the time?
Yeah, no, I mean, Scott, so for me, I mean, it's a couple of reasons. One, you know, I think this AI story has been affecting the stock in a major way over the last several months. Again, the stock is down, to your point, Scott, down 11% year to date. The China news hasn't been good news. You know, it's down 18%. I think that's also priced into the stock. But when I look ahead and I look forward, services is now $23 billion business. It's up 11% year over year. I think about this Google deal, and I think about the integration. I do think they'll probably make some form of announcement in the summer, which I think will serve for the upgrade cycle going into the fall. So that's why I think when you see opportunities with mega cap stocks trading downward like this, I think this is an opportunity to buy in. So that's why we decided to get an allocation now.
The most recent move lower seemed to be related to the DOJ.
Yep.
And the idea, as I discussed yesterday, it's maybe not so much in what the outcome is, but the distraction that it causes at what feels like a critical time for this company, right? You have these quarters of negative revenue growth. Now you're perceived to be, and I use that word and underline it, perceived to be behind in AI relative to what your large cap competitors have announced already. And we figure that's coming WWDC in the summer. But how are you thinking about that issue?
I think it's noise. I think this anti-competitive behavior, I think this has been a story that has come up before, right? And guess what? I mean, the fine 10% of global revenues could be significant. I think eventually Apple will figure out a way to comply and will move along ahead of this. So it's not a major concern for me. I think it's more about, for me, other parts of their business, the iPhone, and what they're going to do from an innovation perspective. So I think this is a separate issue. I'm not terribly concerned about it, and I think they'll see it through.
Yeah, Steph? What do you make of this move now? Stock's at 170. We'll call it that.
Yeah, so 2 weeks ago we talked about it's now 5% of my portfolio. For all of last year, it was only 1% of my portfolio. So I am using the 14% decline, had used the 14% decline, and I might even buy more to be opportunistic. I do think the DOJ could be a distraction, Scott, but this is going to be years in the making.
Right.
I mean, if you go back to Google, it was like 6 years, right? It's going to be 6 years by the time that they settle with the DOJ. Microsoft, it was 3 years. Even this company, Apple, with ebooks, took 4 years to settle. Right. So it's going to be a fine. There's no question about it. But this company's got $100 billion in free cash flow. So whatever the fine is, it's not going to be material, in my opinion.
We said it's not the outcome is not necessarily the issue. It's what Bill Gates himself suggested in the wake of this news. It's the distraction that it causes. You paint the timeline as, oh, well, it's way down the road before a resolution. Sure. You could paint that as a negative and say, well, you don't want the company to be distracted in a significant way for a few years.
I think this company has a huge bench, and so I think they're going to be able to handle it. I do think that they can multitask, and they've proven that in the past. And so when I look at the April quarter, the numbers have been de-risked. Numbers have come down. We all know, as Jason mentioned, we all know how bad China is. Why do you think the CEO is over in China at this point in time, trying to build that relationship back up again? It'll happen. It may take some time, but services certainly is the bright spot. I think in the April quarter, they are going to also announce a new buyback because that $90 billion that they have currently expires or is getting close to it. So I don't know what the number is going to be, but I think it's going to be 90 plus. And then, as you mentioned, Scott, we have WWDC. I like the fact that they're making an acquisition in AI as well. And also, I like the fact that they closed down cars, and now they have $1 billion in CapEx that they can spend on additional AI initiatives. And oh, by the way, they have 2,000 people that were employed for the cars initiative. That all of a sudden they can migrate those people over to AI. So I kind of feel like the risk reward here makes so much more sense to me versus last year when all they kept on doing was missing numbers and the multiple kept on going up higher. The stock is now trading at 26 times forward. It's not cheap by any means, but relative to its history, 36 times, I think is pretty compelling.
Yeah. Jimmy, what do you think?
I'm holding off on adding to it. Obviously, Steffi, you've done that. Jason, you've just done that. I get it. I hope you guys are right. We haven't talked about the technicals, and I know as the fundamental guy, it's like, well, what's Lebenthal doing talking about technicals? But look at the technicals. The 200-day moving average, folks, is sloping down. That's not good in a rising markets. The 50-day moving average crossed below the 200-day moving average, the so-called death cross. These are not, foolproof indicators, but they're pretty good. And the good news for both Steffi and Jason here is you're going to be right if it holds this level. 168, if it goes to 168 or below, that will set up the fourth successive lower low since the all-time high last December. Now, if that happens, I think then I will have been wise to wait. By the way, folks, I own it, right? I'm not hoping for this to go down, but I do want to add to it. I think I'm going to get that shot at around the low 160s. However, if it bounces from here, you guys are absolutely right. So I know it's funny, I'm the technical guy today, but here you are.
Well, look, I mean, we had a technical conversation about this chart looking terrible before the nice rebound that it had, right? People started to write it off. Then it had the rebound. Now you have another move lower, so it remains to be seen.
And you made a good point, by the way. That move lower there was a catalyst for it, right? It was the DOJ action, so it wasn't like the technicals all of a sudden rolled over out of the clear blue sky. So that's a very good point.
Well, it's also like leaning on a scale that was already a little shaky. So
yeah, but I'm just going to tell you again, 168. I mean, I'm looking at the chart right now. It doesn't matter how fundamental Steph, Jason, and I are. You hit that 168 level, I think the sellers are going to come
I think in a year's time frame. That's what I'm giving
Absolutely,
myself.
I'm with you.
And I know you are.
Yeah.
And I know Jason is too. 100%. I may not time it perfectly, but I feel pretty good that I was only 1% weighted in this thing. It went all the way down, and now I'm slowly building it higher. And I probably will be adding to it if it falls below and gets to 160. I'll add another percent. It's actually, it's interesting. Last year it was 7% of the S&P 500 weighting. It's now under 6. So it's come down a lot. So I think that's telling, clearly, but I think that's an opportunity.
Let's talk about another stock that's come down a lot. Leads me back to you, Steph. Well, that remark is indicative of the move in the stock, but also you see opportunity in what's happened with Snowflake.
Yeah.
Because it is of the AI stocks that I'm looking at here in front of me, it's certainly one of the worst performers. It's down 15% month to date, and it's down 20% on the quarter. It's like one of those outliers, whereas so many stocks in that universe have gone up. This one has gone in the opposite direction. Now you've bought more.
Yeah, so it's down 32% post the quarter, which was really not a bad quarter at all. In fact, they grew revenues, total revenues 32%. Product revenues grew 33%. Free cash flow grew more than expected by $54 million. Margins expanded 400 basis points in the quarter. And so, of course, they didn't raise guidance. In fact, they were very conservative with guidance, and that's why the stock got hit, especially at this kind of evaluation. I mentioned to you I started very small on purpose because of the valuation, but I still very, very much believe in data and how it is integral in AI, and these guys have size and scale, and I think the new CEO is kind of setting up the stage for being pretty conservative on forward guidance. So while I was not happy that they didn't raise guidance, I do think the bar is set low. Remember last year, they actually lowered guidance twice. So I think this new CEO is kind of like, okay, let's set the bar low and let's try to overachieve, under-promise, over-deliver, and that's when you get a re-rating in a stock. But I still like the theme overall and the positioning of this company with regards to AI.
All right, let me remind everybody, too, we have a big interview and an exclusive coming up tomorrow. Brad Gerstner of Altimeter is going to join us. Of course, he's a snowflake holder, but it's going to be on all things tech and maybe even more importantly, his Invest America initiative, which he's articulated his goal for what he is trying to do for this country many times on this show. Well, he's made some significant strides, including adding some of this country's best-known CEOs to join his council. We're going to reveal that, and he's going to talk a lot about it tomorrow. Of course, the NVIDIA trade, it's one of his biggest positions, Meta, mega cap, everything. Everything that you like to hear Gerstner talk about, he's going to do tomorrow exclusively on this program, and we're excited about that. Speaking of tech, Jason, so we've had a lot of conversation about where this trade is, at least ahead of last week, or this week.
Right.
Is it done? Is it resting? What's the deal? Well, B of A, their client flow trends suggest that investors aren't willing to give up on this thing yet, right? They're buying comm services and tech. They sold stocks in 11 sectors, not these. Comm services continues to have the longest buying streak of any sector. That's 21 weeks. While tech saw its 4th week of inflows after seeing outflows most weeks year to date. So how do we assess this trade as a whole, as we just hit 2 key stocks within it?
Yeah, no, I think for me, it's a bit of a digestion, right? You know, it has underperformed in the last month. I mean, the Qs are only up a little over 1%. You know, but when I think about, even from a Fed perspective, we haven't talked about the Fed at all today, which is a good thing in my view. You know, obviously it was very dovish commentary last week. I mean, the dot plot, they're committed to 3 cuts, which could be a catalyst for a lot of tech. But forget about, put that aside for 1 second. Cloud and AI are multi-year stories. And it's really nice to see a broadening out in the market. You're seeing energy, what energy is doing, staples, transports, whatever, you name it. Every sector has really started to produce over the last month or so. But I don't believe, I believe that tech is due for a little bit of a break, but this is not something to unload or put aside, because I do think there's continued catalyst there, and it's just a little bit of digestion consolidation right now.
Although, you know, Jimmy, Barclays thinks it could be a little bit more, at least once you finally get, if you do in fact get some sort of broader consolidation or a, you know, corrective phase of any kind, they say that tech could lead it. They say obviously what everybody else says, well, fundamentals continue to support it, being tech. Stretched positioning and technicals could see tech leading the first leg of the next sell-off. I mean, that's an easy note to write and an easy position to take, given the fact that the stocks are up a lot. So it's like, duh. But what do we think about it, though?
Yeah, well, I think the question is, do you act on it? And I would not. You know, look, if you get a correction in the market overall, first off, I don't think it's going to be that deep. I don't even think we'd get a technical correction of 10% pullback on the S&P 500. Why? Because a lot of people have looked at the rally over the last 15 months or so, 17 months, and missed out. And a lot of them have, and they're going to come in. You get a 5-7% decline, they're going to come into the market. Now, if that happens, sure, maybe the note is right. Maybe tech goes down 10%. I mean, the fundamental, there's a line in there about fundamentals being supportive, and that needs to be stressed. These are not nosebleed territory stocks. Sure, we can look at security stocks and see, you know, multiples in the 60s, fine. But if you're going to look at Google, if you're going to look at even Microsoft in the low 30s, even NVIDIA in the mid 30s, these are not insane valuations. So if tech comes off 10%, I personally don't want to add to my underweight by selling tech right now on the theory that maybe it's going to go down more than 10%. What I would like to do is have some dry powder to add to tech, as we were just talking about Apple, if things go down 10% or even 7 or 5%. We'll talk later about some sales I've made, but I have been raising dry powder. I think you need to be ready for some correction, which probably isn't even going to be a technical correction.
But so you're zeroing in on the biggest of the big tech stocks. I'm not necessarily even, I don't want to stop there. Okay. You want to look at some of these returns quarter to date for chips?
Go.
So, I mean, the SMH has...
Scott, do this. You do the returns. Yeah. I'll do the valuation, because in a lot of these, you're going to say, okay, the valuations are kind of supportive. Go ahead.
So, first of all, the SMH is on pace for its best quarter since 2020. NVIDIA is on pace for its best quarter since the Q4 of 2001. So if I tell you some of these gains, NVIDIA's up 91%. These are all quarter to date. Micron 40, Taiwan Semi 34, ASML 30, Applied Materials 29, and so on and so forth. It goes down, you know, 20 for some of these other names. Broadcom's 21, held on this desk. we better be careful about how we look at the whole tech space. Don't just focus on mega caps. Let's look at some of these absolutely crazy charts in the chips.
Your point is well made, and I'm just going to, Micron, that was the only one I had time to pull up. You know, at this year's earnings.
Micron's up 40% in the quarter.
And here's the rub on it. You know, you look at this year's earnings 177 times. You look at next year's earnings 16 times. So what's going on here? Micron is a really cyclical chip. And at 16 times next year's earnings, that's pricing in a recovery from the demise of 2022, 2023, when we had all of that, you know, the payback for the double ordering and the inventories of customers. But your point, Scott, could be writ even larger. I mean, you can look at some of the software names. You know, Oracle's had a great run. Still trades at around 20 times forward earnings. Google, actually, you know, for all of the lambasting that it's been getting recently, it's had a good return, and yet it's roughly 22 times this year's earnings, 19 times next year's earnings. The point I'm making is not to disagree with you. The returns are stellar. But in a lot of these technology names, the valuations are still, I would say, somewhat attractive, and I don't think I want to get more underweight as I already am.
I mean, I've been more focused on non-tech as I'm diversifying the portfolio into some of the sectors that have lagged. We've talked about energy, industrials, financials. Believe it or not, those sectors are actually beating technology as a whole. If you look at the XLK, XLK is up 9%, and these other sectors are up 10. No one's really even talking about that.
Well,
and that's because the earnings, earnings are better than expected.
To your point, tech is only the 6th best sector. It's been dominated by the things that you're talking about.
Exactly, and that's because tech's already run. We already know a lot of these stories. Not to say that it's over, but I don't think you want to chase these names. I own Broadcom, I own Lam Research, I love them, but I'm not buying them. And in fact, I was trimming some of them, and I would continue to trim if they continue to go higher. I love the stories long term, but I see much better value in these other sectors because earnings were better than expected, and we are seeing a broadening out. And what did Powell say last week? GDP is stronger than expected. All three of us have been saying that for years, by the way. So now the Fed agrees with us.
You've been front running Powell.
We're front running Powell, but happy to do it. And at the same time, inflation's still stubborn, but it's come down. All of this means earnings are better than expected. That's good for stocks, and that's good for the broadening. And that's why I'm not chasing tech, but Apple down 14%, Snowflake down 32%, IBM, if that pulls back, I would add to that. CDW. Like, I have a whole bunch of names. I just think that there are other places that are more compelling at this point.
Well, don't go spilling the beans yet on a number of moves you have, which we're doing in the B block, okay? Before you take that and make that next sentence. No. All right, because you bought 1, 2, 3. You bought 3 and you sold 2.
Yeah.
We're doing that in the B block, so I don't want to, speaking of front running, I don't want to do that. What about the chips? Are we vulnerable, or are we just fine?
You know what? I think we're just fine. You know, listen, I mean, NVIDIA's the main story, obviously. They're up 90% year to date, quarter to date. You know, the numbers are crazy, right? And, you know, we had their conference last week. They're announcing a bunch of partnerships, deals. I mean, it seemed endless to a certain degree. But what I will say, and Jim made this point, I mean, the semis are cyclical stocks, right? So we have to be mindful of that. You know, I don't think we're anywhere closer.
They're not trading that way.
No way, not at all, not at all.
And maybe they're not that much. Maybe
they're not as
maybe
cyclical
AI
as you
has changed that game.
Possibly.
Definitely.
Possibly.
It's definitely changed the name of the game. You've got Broadcom has earnings power of $70 to $75. We were talking about 50 just 2 months ago.
100%.
Right? And the same thing, Lam Research, their advanced packaging business is up to $1 billion, up threefold in a year's time, all because of NVIDIA's platform. So their earnings power is awfully high, too. I'm just saying, my point is I don't want to chase them here, but I recognize that AI certainly has changed the game to a certain degree. You just want to be a little more price sensitive and valuation sensitive,
100%,
right?
100%.
That's the key question as to, you know, whether this whole AI play and this transformative technology has prolonged a cycle longer than we're used to it running.
Yes. Sure.
Now, a lot of these, you have to figure that a lot of it's in the stocks, right? You don't just jump the way these stocks have jumped and figure that nothing's in the names. But it could still be prolonged much further. It's just a great unknown. Just don't know. Double ordering, things like that. You don't know.
That's very well put. We really don't know. Double ordering will show up, and triple ordering. It will show up. I have no idea when. But to the question you're asking, I intellectually look at two different types of chip stocks, the AI chips and the non-AI. And if you look at the last 2 years, a lot of non-AI chips have really, really languished. I mean, do I have to go into Qualcomm? Sorry, Jason, do I have to? NXP?
We're both in it.
Right. And, you know, 2023 and 22, frankly, these were not not good years for those stocks.
Right.
Now they're recovering, but they're not recovering on the basis of AI. Yes, Qualcomm is probably in its quarter going to come out and say, hey, you know, we're getting AI on the edge in your phones, but that's not what Qualcomm moves on.
Qualcomm's
a cyclical.
It's up 16% in a quarter. It's not like it's done absolutely nothing. It just doesn't look as sexy next to a Micron, an NVIDIA, or an AMD, or a Lam, or a Taiwan, or an ASML.
And I think therein lies the story that I'm paying attention to on a day-to-day basis, that a lot of stocks, not just in tech, which have languished, I mean really languished, and I've taken some heat for it appropriately, you know, for hanging on to these things for a long time, have started to really recover. I mean, outside of tech, you can look at financials, industrials. We've done this many times. Look at energy, right? Look at one of the things I get kind of laughed at for holding quite a bit, GM. I almost don't want to mention it because it's a jinx, but man, what a run.
52-week high.
From 27 to 44, and I have to say this, right? When the UAW strike was settled and all the headlines were, look at how the UAW pulled one over on management there. Ha. Don't believe headlines, folks. Do your own research.
I'm actually looking at the cybersecurity names. I'm kind of hoping Fortinet was a dog last year. It's up 15% this year. I'd love to buy that if it pulls back, and it could in a day. We know how volatile cybersecurity is. It's going to be a $1 trillion total addressable market, and that's lowballing it. Every single day we hear about a cyber attack. Even cybersecurity companies are having cyber attacks. When that happens, you know things are just not working. And what we are hearing from CTOs is that you're seeing a consolidation. Companies don't want to have 10, 15 vendors. They want to have 5. So you pick the big 5. You want to pick a name? Palo Alto, Fortinet, CrowdStrike, whatever. You could also pick Hack, which is the ETF, which I would recommend because it's a little less volatile. But Fortinet is doing a lot of right things, and that's one that's absolutely on my radar should it pull back.
I'm glad you brought up that sector because, you know, if you got chips and software, now these are part of that software, obviously, but cyber, those stocks, like charts look like, for the most part, look straight up, too. We do continue to follow the bridge collapse in Baltimore after a cargo ship hit the structure earlier this morning. Our Eamon Javers is there with the very latest. Eamon, what are we learning this hour?
Well, Scott, we're going to hear from the President of the United States coming up later this hour. We expect to get more information also from the NTSB coming up at 1 p.m. Eastern Time. As you take a look now at this cargo ship, the Dolly, nearly 1,000-foot-long cargo vessel, now wedged in among the wreckage of the Francis Scott Key Bridge here at the Port of Baltimore. You can see the wreckage of the bridge still on the hull of the ship there, which is piled high, 6-7 cargo containers high on the deck of that ship. Still, we can see the engines do appear to be running on the ship. There is smoke coming from the smokestacks on it. No movement at all since it impacted that bridge at about 1:30 a.m. this morning. We heard from the Maryland governor, Wes Moore, earlier today. He's described the moments at which the ship issued a mayday call, which gave enough notice for some action to be taken here at the port. Take a listen.
I'm thankful for the folks who once the warning came up and once notification came up that there was a mayday, who literally by being able to stop cars from coming over the bridge, these people are heroes. They saved lives last night.
So, Scott, clearly the human toll here could have been a lot worse. As it stands right now, there are 6 people still unaccounted for. 2 were rescued. 1 rescued and sent to the hospital. 1 person was able to get out of the water on their own, and officials say they have spoken to that person and verified his conditions. So there are now 6 unaccounted for. This is still officially 11 hours in now, a search and rescue mission. They say they have divers on the scene as well as people on the surface and helicopters circling above us. I asked the governor at that press conference, Scott, if there's any indication now of when they might be able to remove that wreckage and reopen the Port of Baltimore. That wreckage right now is across the entire span of the river here that gives access to that port. He said it's simply too early to even begin to give any estimate of that. All of the shipping coming into the Port of Baltimore, including all of the cars that come in to the east coast of the United States, or the bulk of them, all of that is now being shut down, and it's not at all clear from the governor on down, from any of the officials here, when they'll be able to reopen this port. So a major economic impact here, Scott, and no deadline for the recovery. Back over to you.
All right, Eamon, I appreciate that update live from Baltimore. That's our Eamon Javers on scene. Thank you for that. Up next, more committee moves. I told you Stephanie has a bunch, so we're going to go through those a little later on in the program. Farmer Jim's got a few of his own. Halftime's back in 2 minutes.
Insurance.
All right, we're back. Time to go to the Linkster for these moves that I told you about earlier. Okay, so you bought 3M or you bought more 3M?
3M.
You bought 3M.
I bought 3M.
Okay. Okay. Tell me why.
I think this is GE 2.0.
Okay.
I think that this is a conglomerate, and they are spinning off pieces. They are going to spin off their healthcare piece. We know that. But I think there's a lot more that they can do. But what really got me jazzed up was Bill Brown. He was L3Harris's CEO from 2012 to 2022. The stock was up over 400%. He gets things done. He may not be Larry Culp, but he's pretty close. I think the valuation at 10 times forward estimates is extremely cheap. They're paying down debt. They do have litigation. They do have lawsuits. It's not clean, but this is exactly what GE was many, many years ago. It wasn't clean and very hard to buy, but I think if you have patience, that I think that you will be well rewarded.
Okay, now you have had to wait a good while for GE.
Yes.
Right? At the expense of like catching a lot of flack about, oh my gosh, this thing's not doing anything. When's it going to turn around? You can't turn around a freighter that quickly. You were willing to do that, and you're being rewarded now. How long do you think you're going to have to wait, if at all, for the kind of turnaround that you expect for what you've already determined to be a GE 2.0?
I think that their businesses are healthier than what GE's businesses were at the lows, at the low point. Remember, this is a conglomerate. They have a lot of pieces. They have industrial, transportation, electronics, consumer. I mean, a lot of these businesses are good. And by the way, like 70% of their revenues are overseas, around the world. So to the extent you think that the global economies are kind of thawing, getting a little bit better, which I do, then I think that these guys should do well. By the way, the 10 multiple compares to 20 times over his history. It used to command a premium multiple because of the premium businesses. It's lost its way, and I think that Bill Brown is going to be able to fix it. So I actually think it won't take as long, Scott. That being said, it's a 200 basis point position for me versus what we talked about Apple of 500 basis points.
Sure.
Right?
One you could add to.
Sure.
But you hope, I mean, you're basically hoping that Mr. Brown pulls a Culp-like
he will.
turnaround.
He absolutely will.
So you're betting on the person as much as you are the fundamentals, if not maybe even more so on Brown.
Yeah, I have to kind of do that, right? I mean, certain CEOs, that's what makes the story so fascinating because of the prior track record. These aren't businesses that are hard to fix. Distribution, efficiencies, productivity, margin improvement, they're not hard to fix. I think GE was much harder to fix. I mean, renewables and power was a struggle. Healthcare was amazing, but underneath the big umbrella was very poorly run. And then aviation had potential, but again, it wasn't great execution. They had a lot to do. Culp had a lot to do. He fixed it. I think Brown doesn't have as hard of a lift. So again, it started off small, and I'll probably add on any pullbacks.
Jimmy, what were you going to say?
Well, what I'm wondering here, obviously, everybody wonders about the litigation.
Yeah.
You addressed it. You said it's priced in. High dividend yield. Here's what the question is. Buying back shares. Can they buy back shares without the litigants in their various cases saying, hey, look, they got more money, and, you know, that's...
And they're probably not going to right away.
Yeah, they got to get that settled, right?
Yeah,
okay.
but the stock is at this valuation, it's cheap enough that I think that's not expected at this point. Buybacks and by the way, I also wouldn't be surprised if they come in and cut the dividend. I wouldn't.
Well, that would be kind of scary, right? I mean, that's usually a sell that moment.
They're settling all this litigation. The free cash flow is a little bit better than expected. They're paying down debt. So I don't know if they are going to cut the dividend, but I wouldn't be scared to say that all of a sudden things are in shambles. They're just not, just based on the balance.
So the other one, Freeport, that's a new buy?
That is a new buy. I've been in and out of it, but I do think, as I mentioned, if I think that the global economies are sort of poised to rebound, this is very tied to copper prices. For every 10 cents of share in copper price change is $430 million to EBITDA and $340 million to cash flow. And oh, by the way, their debt has gone from $6 billion to $400 million. And so they've been talk about paying down debt. They've done a great job there, and I think the valuation is pretty attractive. This is definitely a bet on the global economy's rebounding. The stock is not going to do anything if that doesn't happen, but I do think it is going to happen.
Okay, you bought D.R. Horton, DHI.
I did. I bought D.R. Horton. I've been talking about housing. You know, housing is my favorite sector. I just think that seasonally, this is exactly the time when you want to own the home builders. Yep. We saw KB Homes this morning where orders were up 55% sequentially in the quarter. Gross margins were better. And the company, KBH, was talking about incentives coming down a little bit more because demand is a little bit higher than expected. That plays right into D.R. Horton. They have a play on the Southeast. That's 51% of their total revenues. That's where you're seeing growth in homes. And also the people, their first-time buyers, exposed as well. And that's exactly where I want to be. 11 times earnings versus 13 times historical. It had a nice run last year. I'm right-sizing it to start. On pullbacks, I would definitely add to it. But I already own Home Depot in a very big way, so I'm placing a bigger bet on housing.
If you're placing a bigger bet on housing, why are you selling Sherwin-Williams, SHW?
Just because I made 20% off the lows, and I think that, and it's also more expensive. It's not that I don't like it. I just didn't have any cash. And so D.R. Horton, to me, is more compelling at this valuation, and it's really more of a pure play in terms of housing, so there's a little more beta, a little more juice to the story.
Okay, what about Bristol-Myers, which you sold as well, BMY?
Yeah, I eked out a 6% gain in that stock, and I'm calling it a day. I mean, I know, Jimmy, I know you've been there, and then I'm like, great, we made some money. I like this story very much. I do think it's very cheap. I also think the dividend is very safe. The balance sheet's great. But this is a company that's rebuilding its pipeline. It's going to talk about years. This is going to take years to actually unfold. And so taking my money and putting it elsewhere.
All right, let's get the headlines now with Bertha Coombs. Hi, Bertha.
Hi, Scott. Secretary of Defense Lloyd Austin met with Israeli Defense Minister Yoav Gallant this morning and said that it was a, quote, moral imperative to protect Palestinian civilians. The meeting comes at a tense time between the two nations after an Israeli delegation pulled out of a planned meeting in protest of the United Nations resolution for an immediate ceasefire. The Labor Department found immigrant children as young as 14 years old were working illegally around heavy equipment at a Tennessee company. The company, Tough Torque, makes lawnmower parts for brands such as John Deere. The company was fined for hiring 10 children and must set aside $1.5 million to help them. Its majority owners said that the children were temporary workers who were not hired directly by the company. And after a weekend of outages, Panera Bread's website and app are slowly coming back online, though not fully operational. Silicon Valley Daily first reported systems for the restaurant chain went out on Saturday morning. Panera has yet to make a statement on just what caused that outage. Apparently, even the displays in the stores, Scott, were down. Back to you.
Bertha, appreciate that. Bertha Coombs, thank you. Up next, our calls of the day. The committee debating the strategy on Netflix, plus a bullish note on the big banks as well. We'll be back after this quick break.
The NBC.
Welcome back. Julia Borston joins us now with a news alert. Julia?
A news alert on the NFL. Peacock will exclusively stream the NFL Friday night opening weekend game on September 6th, and it will be from Sao Paulo, Brazil. This will be the third game streamed on Peacock, and it follows the big numbers that Peacock got for its wild card game at the end of the last season. And this will be the Peacock will be the exclusive national home of the NFL's first ever regular season game in Brazil. So a lot of firsts here. Scott, back over to you.
All right, Julia, appreciate that update. Julia Borston. All right, calls of the day. Let's hit Netflix first, Jason, which you own. It was removed today from Bank of America's best ideas list. They do reiterate buy, so you always got to be careful when you talk about these, top lists. Right. They're not taking down their rating on the stock, and that's perhaps most important. Shares are up 91%, though, in the last year. How do you view the stock in the here and now?
Yeah, listen, I'm likely not adding here. It's trading at 36 times forward. It's up 28% year to date, but they've won password share. That I think is working well for them. The ad-supported tier is also working. Live sports, their foray and the partnership with the WWE. I like all the deals that they're working on. The concern for me is content. right? So content, obviously, through the strike through last year, is challenging for all the players, but I do think Netflix is ahead because of the licensed content that they already have in the library that they've already built. So I wouldn't add here, but I continue to like it.
Let's talk banks, because Morgan Stanley's Katie Huberty says of the U.S. large cap banks, we're bullish on the ongoing capital markets rebound. We see money center banks as a way to play that dynamic. Our team believes that the money center banks, Bank of America, Citi, Goldman, and JP Morgan, all of which they have overweight, are a way to play this view. Now, we do have ownership, Steph. You go Bank of America and Morgan Stanley, your two largest positions.
Yeah.
So you must agree with Ms. Huberty, Morgan Stanley.
I do. We've been talking about capital markets recovering. We've talked about M&A, equity capital markets, debt capital markets, investment banking, the whole thing. We are seeing a recovery. There's no question about it. When it will be appreciated, I don't know. But Bank of America trades at 1.1 times book, 2.6% dividend yield, which I believe will go higher, very well capitalized, and their expense management is phenomenal. On Morgan Stanley, it's more of a mix, right? They have capital markets, and then they have wealth management. And that wealth management is 50% of their business. So maybe not as levered as Goldman Sachs per se, if you're playing capital markets, but I do think you're starting to see a recovery in the wealth management space. In fact, Schwab, which I recently have added to, their NNA in the month of February actually rose 4.7%, which is really one of the highlights in terms of getting new assets. And I think that bodes well for all of the banks in general. That has been a real sticking point, not only for Schwab, but for the group. So I like those three names. Those are the ones I have been adding to on weakness.
Jason, the return of capital markets is a big deal for your Goldman Sachs.
Absolutely. Absolutely. And that's why we own it, because I do believe capital markets, deal volumes, all will pick up in the second half. The stock's only up 5% year to date, but it's encouraging to see even the Reddit IPO, like how well it did, and starting to see other names come to market. So that's the play for me as it relates to the financial space. And also, I would say, I think it's important that we are seeing less interest rate volatility. I think that'll play well for the money centers and deal volume and loan volumes to pick up.
So, Jimmy, you were on yesterday. We talked about Citi, right, which I think it was Mayo at Wells was, extraordinarily bullish about, which he has been for a while. So I don't want you to give me that today, but JP Morgan is the other one you own. But what about this call? Now's the time for large cap banks, both, ones that sort of excel in capital markets, but also money center banks that'll do well in a good economic and maybe lower rate environment.
I think it gets a little tricky here, and that may surprise people to hear me say that. But you got to look at the short term here. Over 6 months, the XLF is up 25%. That's the diversified XLF. I mean, that even includes Berkshire. So there's been one heck of a run in banks, and XLF is mostly money center banks. So JP Morgan's had a heck of a run. Goldman has had a heck of a run. Citi has. And it gets hard to put new money to work here. Now, all that said, I think these stocks have a lot more room to run because of what Steph and Jason just said. All I'm saying is at some point, much like the market, okay, or much like the semis that we were talking about earlier, at some point, there's got to be a little pause, a little bit of a give back. I will put new money today to work in Citigroup and JP Morgan, but not a lot. I've got to respect the rally that's come. Long term, I love these. I love these long term. Short term, it's a little tricky.
A lot of the companies early in March, Scott, actually reiterated guidance. So I don't think the numbers are really at risk. It's really where do you see the acceleration? Where do you see the momentum in capital markets, right?
To flip my own comments on me that I said to Scott, the valuations are really quite attractive.
Yeah.
I mean, they're really quite attractive, kind of 10 times earnings, good, decent yields. Citigroup at 70% of tangible book value. So you got to look at both parts, what they've done and what the valuations represent.
All right, quick break. We'll come back. We'll document some of Jim's new moves, and Mike Santoli is going to join us with his midday word.
So the Fed makes no bids for this 5-year note auction.
Protect your trades from macro headline risk with Financial Juice Pro. Now only $99 a year for our real-time service.
Covered.
Our senior markets commentator, Mike Santola, here at Post 9. So I get we're up across the board. It still feels like we're really not going to be willing to place any sort of bet until we see PCE, especially given what happened with the most recent CPI and PPI.
I would say until you see PCE, till you get through the end of the quarter, and maybe you're going to even have to start to get into sort of pre-announcements and jobs report. Right now, the market sort of reveals it's sort of bias, or it's, path of least resistance, which is drift with a slight upward bias. It's a 50-50 day, again, below the surface. It makes sense. To me, it all starts with super calm bond market because of a lack of huge disagreement on the macro. And then the rest of it is just sort of short-term stuff, tactical. People are fully invested, but this is not the way a market typically peaks ultimately. And so people feel right now that they're willing to ride out the next pullback. And that's how the market acts.
Sorry to interrupt you. The economic data today wasn't great.
No, it's not great.
Consumer was weak, and what was it? Another manufacturing week. Philly Fed.
Yeah.
Not
great.
No,
it's getting choppy. And inside of the consumer confidence number, the one that said like their own people's own household finances present condition eroded a little bit. So you don't, extrapolate too much from those things. But I think we have to be on alert for any deviation from the ideal economic path, which I think is now being embraced.
All right, good stuff. I'll see you on Closing Bell. That's Mike Santoli, our senior markets commentator. Coming up next, we have more committee moves. The two stocks Jim Leventhal is selling. He'll tell you what they are next.
At 1 p.m. Eastern Time, the US sells $67 billion in 5-year notes, prior bid cover of 2.41 and a prior high yield of 4.32%. And taking a look at some analyst notes, despite declining yields since the last auction, JP Morgan strategist.
All right, we're back with those committee moves from Jim Lebenthal that I said we had today. So let's start. That was the second one. You sold New York Community Bank, which I was surprised that you got into in the first place. So you can give us the reasoning here.
Yeah, first the trajectory. So it was about a week and a half ago. I decided to take a flyer on it. It shot up to 4. I felt like a hero pounding my chest. The very next day, there was an analyst downgrade. Comes down, and it comes right down over the last few days to the price that I bought it, and just said, nope, I'm not going into a loss position with this. I'm over here in the corner playing with matches. Nobody's stopping me. I'll stop myself before I get burned.
Sure. I mean, I remember the day that you did it, and I think the stock was at like 370, 360, something like that. And I think one of the reasons why you got into it in the first place, you're like, well, you know, former Treasury Secretary Mnuchin has sort of come to the rescue. He's like the white knight here. I trust him and the team that he's put together moving forward. I felt like your reasoning was more along those lines, almost, I don't want to say, and I don't want to be disparaging to you in any way by suggesting that you were more enamored with that and ignored the fundamentals of the business, which even with the rescue remained challenging. Let's be clear. That's why the stock is sitting where it is.
I don't take that as disparaging at all. That's accurate. I do very strongly still think that the Steve Mnuchin put, I'm just making that up.
No, but that's what you said at the time.
Yeah, no, but I'm not backing away from it. What I'm saying is this stock can go lower before it realizes whatever Mnuchin's exit price is going to be. And I don't want to be sitting at this at $2.60 when I bought it at $3.40. I just don't need that. I've got a lot of things working right now. I don't need to be worrying about New York Community Bank and when its full value will be realized. I have no interest in it. I lost interest in it.
Okay. And you sold Greenbrier, which, to my recollection, you've been in for a reasonably long period of time. I remember you talking about it for a long time.
In and out, Scott. I get in and out of this. And if you look at a long-term chart, I mean, the stock kind of cycles between 25 and 50. I am, trying to raise a little bit of cash here because who knows? You look, if Apple goes down, if Steffi and Jason maybe bought too early, sorry to say it that way, and I get a bite at the apple, I want to have some dry powder, or maybe to add to some of the things like AMAT or Amazon that I recently bought in small size. I have to have some dry powder. I hate that thing where the market goes down and then you're selling this and buying something else. That doesn't feel good. So wanted to raise some cash. If the market goes down, Greenbrier is likely to go down with it. It's a beautiful little industrial, bending metal into rail cars. I do love it. Likely to be back into it if it goes below 40. So stay tuned. I do cycle in and out of this. It's my main sort of cyclical play there.
All right, let's do final trades after this quick break.
Israeli official says hostage talks with Hamas are at a dead end. Israel's negotiators packed up and left Doha. At 1 p.m. Eastern Time, the US sells $67 billion in 5-year notes, prior bid cover of 2.41 and a prior high yield of 4.32%.
Please get your slip-ins.
Well, we have some news just crossing that we want to alert you about. Take a look at shares of Boeing on an intraday, taking a little bit of a move here, down about 1%. News that Moody's has now placed the ratings, the credit ratings of this company on review for possible downgrade. And that is on Moody's belief. They say that Boeing will be unable to deliver 737 narrow-body aircraft at the volumes required for it to materially expand its free cash flow. So that's a story we're going to watch for the rest of the afternoon. Another reminder, Brad Gerstner, exclusive with us tomorrow on the Halftime Report. We're excited about that. I hope you'll join me on Closing Bell at 3 o'clock this afternoon. Liz Young, Courtney Garcia, Jason Hunter will be joining me then. So I'll see all of you in a couple hours. Let's do final trades. Farmer Jim, why don't you start us off?
CVS coming back strong. You know, there was some news today about Amazon delivering prescriptions, and the stock was down over 1%, and it stormed back. It's in the green. Chart looks good, by the way.
Okay, Jay Snipe.
Costco EPS growth was up 19% in the last quarter. It's been a little bit volatile over the last couple of weeks. I like this one.
All right, and the Linkster.
Target, I think they have $10 a share of earnings power.
All right, good stuff. I'll see all of you on Closing Bell. The exchange begins now.
It does indeed. Thank you very much, Scott. Welcome to the exchange. I'm Wilfred Frost in for Kelly Evans, and here's what's ahead on the show today. We're in a debt-fueled, buyback-driven market, says one of our guests. He sees that extending the bull market for years. He also sees scary corrections along the way. He's here to make that case. Plus, Japan's stock market hitting record highs, but it's not too late to get in. We look at where the biggest opportunities are as we continue our trip around the world this week. And this stock down 30% from its May high, the company at the point of maximum stress. That's exactly why one of our guests likes it here. He'll be here with why now is the time to buy that particular name. But we begin with a look in on how markets are trading this lunchtime. And as you can see, we're up about 0.2% or so on each of the major averages, and that means we're on pace for the first positive day in 3 for the S&P and the Dow. The Nasdaq, meanwhile, is set for its 6th positive day in 7, currently on track for a record close in and around that level. 16,428 spot 2 is the level we're looking at. So as you can see, in fact, we're just a little bit shy at the moment, need another sort of 10 basis points of gains or so. Well, for the year, if we broaden out, the S&P 500 up about 10%, and those gains may be set to continue because my next guest says, as I said at the top, we're in a debt-fueled, buyback-driven market, and that will fuel the bull market for years to come. But it will also contribute to some scary corrections. Joining me is Brian Reynolds, Chief Market Strategist at Reynolds Strategy. And also Bob Pisani is here as well to talk us through the key talking points of this story in the buyback picture. Bob, break it down for us.
Wilfred, always good to see you. Corporate America right now is flush with cash and buying back a near record amount of stock this year after a record 2022 when $950 billion in stock was bought back. 2023 was a mild disappointment due largely to a lack of earnings growth, but 2024 is looking like a near record. Jeffrey Yale Rubin at Barini Associates estimates that companies announced $187 billion in buybacks in February alone. That would be second only to the record of $225 billion announced in February of 2022. Now, a good chunk of the buybacks seem to be driven by record profits in big tech, and that makes a lot of sense. Corporate America has recently shown a preference for buybacks over dividends and capital expenditures. The main reason seems to be that buybacks can boost share prices because they reduce shares outstanding, and in theory, they improve earnings per share. They're also a lot more flexible than dividends. A buyback, for example, can be discontinued much easier than cutting a dividend. But remember, Wilf, it all depends on cash flow. As long as that's strong, you got buybacks.
Bob, stick around with us for this discussion because there's so many areas to explore. And Brian, great to see you. In the headline, we're saying debt-fueled buybacks. I mean, and that's a good thing. Surely buybacks are a good thing when stocks are cheap, and they're not particularly cheap, and when it's being funded outside excess earnings, excess revenues, but not from debt. So talk us through why debt-fueled buybacks now is a good thing.
Well, in general, the credit market's on fire. Companies have been able to borrow record amounts of debt this year. That was not the case last year. And most of that money is going into buybacks, including the cash flow that companies are driving. More importantly is how much they can borrow. The credit markets are on fire. In the long run, that's good for stock prices. In the short term, though, it's gotten a little bit overdone, and I think we're due for a pullback.
It's so interesting you say that in the long run it's good. I can perhaps see the opposite argument why in the short term it's good for stocks, because there's a buyer out there. In the long term, if it's funded by debt, surely there's going to be a comeuppance at some point.
Well, there's always a comeuppance. So we had the comeuppance in 2000, 2008, and in 2020. But each time that was from a higher low. So over time, stock prices go up because of the buybacks. But in the short term, buybacks lag stock prices. So last year, stocks went down because buybacks petered out, because the government was borrowing too much money, people felt, from August to October. But in October, I pointed out on this show that the government was done borrowing money. They'd hit their targets, and that sent the buybacks into overdrive. So we've had a move since last October through now from one standard deviation below the trend of stock prices to one standard deviation above the trend of stock prices. That's a huge move in the last 6 months. It's probably overdone. And when you get that type of a move, that's when the buybacks slow down temporarily as corporations husband their cash. They think we've done enough to boost our stock prices, and they don't start the stock prices again or the stock buybacks again until stock prices have gone down or had a correction of about 10%.
It's really interesting, Bob. I mean, Brian, I know, is not saying this explicitly, but one could extrapolate a little bit as if buybacks is the only driver for markets, and if they dry up, then they'll correct. What's your take on that? How important, Bob, are the level of buybacks for overall market levels and sentiment? And do you agree there with Brian's take that we might be a bit stretched to the upside in the short term?
Yes. Here's the problem I have. It's one thing to argue when you're buying back stock with cheap debt, like it was a couple of years ago, but that's not so cheap anymore. And I think companies are going to be a little more careful buying back debt when the cost of borrowing is a lot higher. So that's one natural break that I see out there. Other than that, it's interesting to watch the competition. I've been doing this for 25 years. You've been doing this a long time, Wilf, too, between buybacks, dividends, and capital expenditures. There was a time when dividends were a lot more popular. Corporate America's pulled back a little bit because they like the flexibility of buybacks. And it is an interesting way to return cash to shareholders, providing you actually can reduce the share count. And there are some situations where they don't actually do that. Some companies are now doing dividends. Meta just announced a dividend, for example, in addition to a buyback. So there is competition out there. The key story is, what does corporate America do with the cash flow, with the excess cash flow? President Biden wants them to go and suddenly spend more on capital expenditures and hiring people, but that's really a function of the economy. So I don't have a problem with corporate buybacks. I have a problem with doing it when they're having to use debt to do that, and the cost of the debt is a lot higher.
Gents, stay there if you will. I want to get into all of this in a bit more detail, particularly the dividend argument, Bob. But we have a news alert, first of all, to bring you on Apple. We're going to discuss the consequences of this news alert that Steve Kovac has for us.
Hey there, Wilf. Yeah, so Apple's annual developers conference is going to take place on June 10th at the company's headquarters out there in Cupertino, California. This is the annual developers conference where they typically do new updates to all the software for their various devices, iPhone, Apple TV, iPad, and so forth. But the reason this one is so important, Wilf, is because this is when we're expecting Apple to make its artificial intelligence announcement. After the last earnings report, just a couple months ago, Tim Cook, the CEO of Apple, teased that there's going to be what he called breaking new ground in artificial intelligence for Apple. The huge question for investors, where Apple fits into this AI revolution that we're talking about. They don't have the same kind of clear narrative that maybe an NVIDIA or a Microsoft does. So what kind of features that would incorporate and so forth. We also learned last week that Apple has been in talks with many potential partners for its AI products. That includes Google with its Gemini product and China's Baidu for its ErnieBot artificial intelligence product as well. So huge stakes, a lot at stake here for Apple. For this artificial intelligence announcement we're expecting on June 10th, Will.
Steve, we look forward to that and your coverage of it. Let's go back to the panel. Brian and Bob are still here. Brian, why don't we touch on Apple quickly? It's a great example. I mean, it's off its highs, but not by much. And over any long-term perspective, clearly it's done incredibly well. And on various multiples, it's relatively expensive. Should they not prioritize dividends over buybacks at these levels?
So I think, in general, stocks are overdone relative to debt levels. So I agree with Bob. It doesn't make sense for companies to buy back their stock at this levels, especially for a really expensive company like Apple, because Apple's bought back their stock and seen investors redistribute it to other names. There's one other factor here, though, that also plays into Bob's argument, and that's IPOs, initial public offerings. When stocks are down, there are not many IPOs. But when they go up, that means companies want to sell stock. And we had a very successful IPO of Reddit last week. That's going to encourage more companies to bring stock to market. So instead of doing buybacks, they're going to be doing issuance, which is why I think in the short term, this is going to be a negative for stocks. We're going to go from a buyback overheated market of the last 6 months to fewer buybacks in the next 4 or 5 months. That will probably make a correction. And then when values get better, then the buybacks will pick back up.
Bob, final word to you.
Well, again, I agree here with the point being made. You want to buy back stock generally when the price of your stock is perceived to be cheap as opposed to future earnings potential. So how's the market valuing? Apple's had a little pullback recently, so there may be people out there arguing that actually now would be a good time to buy Apple with a roughly 10% pullback. Again, this is always a careful balancing act. I know a lot of people that want cash in hand. They like the dividends because it's actually real cash. And it's not something that's sort of intangible like a buyback is, where you're hoping it reduces the earnings per share. It's a big debate. We should have this problem. Right now, corporate America is flush with cash, and that's what the good news is. That's why the stock market is holding up so well.
Gentlemen, great discussion. Thanks so much for that. Bob Brown discussing the debate between buybacks, dividends, and whether they should be debt-fueled or not. Right, let's go around the world as we've been doing so far this week, and we'll continue to do this week here on the exchange. Well, Japan's stock market hitting record highs last week for the first time in over 3 decades. That's paid off big time for Berkshire Hathaway, which began building a 5% stake in 5 of Japan's biggest publicly traded companies back in 2019. Berkshire upped that investment by 3.5% last year, with Warren Buffett saying he could be open to increases beyond that down the line. And while Buffett was early on Japan, our next guest still sees plenty of untapped opportunity from here. His Japan fund is up 16% so far this year. Joining us for more, Shantaro Takuchi, Matthew's Japan Fund Portfolio Manager. Very good to see you. Thanks so much for joining us, Shantaro. So just give us a snapshot quickly of what the valuation multiple is on the Nikkei at the moment.
Sure. Thanks, Buffett. So right now, Nikkei index, which consists from mega caps and large caps of Japanese companies, is trading at 22 times forward earnings, which is at a 10-year high. However, if you look at the broader index, for example, like the Topic index, it's trading about, give or take, 16 times forward earnings, which is still about a median of the previous 10 years. Japan is one of the very few markets which has a positive earnings momentum and also a positive revision that is still trading within the 10-year range. Other markets, such as the U.S. and India markets, are trading at 10-year highs.
But that's really interesting. I mean, those valuation multiples are steeper than I thought you were going to say. So I guess you just touched on it there, but talk us through the attraction of buying stocks at that price. Is Japan about to grow at 6% GDP per year?
No, I think there's still a big perception gap amongst global investors. When we talk about investing in ASML, for example, do we worry about Dutch domestic economy? But some or the other, when global investors think about Japan and Tokyo Electron, they worry about Japan's anemic GDP growth. But at the end of the day, as active investors or Japanese equity market investors, we invest in Japan corporate profit growth, which has been extremely robust over the past decade. And going forward, it has been and it will benefit from global manufacturing cycles. And on top of that, there's ample upside with regards to increased share buybacks and dividends.
And talk me through that, the sort of sense of shareholder returns and the priority that management gives to shareholders. Is there a lot of dividend payouts at the moment? What are the yields on some of the key names you own?
So currently, the Japan market on average is the dividend yield is about 2%, and buyback last year was record high at $65 billion, which buyback yield is about somewhere between 1 to 1.5%. The important thing here is corporate Japan is sitting on $1 trillion of cash on balance sheet. More than 40% of the Japan listed companies are net cash. So unlike the U.S. companies, which is borrowing money and buying back shares, actually increasing buybacks and dividends for Japanese companies is not to decline the ROE, because the cash flow accumulation has been much faster than the deployment itself.
That's really interesting. And then just talk to me about what your assessment of what the Bank of Japan has been doing over the last 6 months is, and whether it's the right move. Like, obviously, coming out of zero interest rate policy, have they come out of that a bit slower than you might have expected, or are you ultimately content with their actions?
Yes, so I think the BOJ actions, basically raising rates, moving out of the negative interest rate policy, is an important milestone to actually see real wage growth in Japan happen, which is critical for domestic consumption. However, at the same time, Governor Ueda has stated that BOJ will continue to be accommodative in its stance on a relative basis compared to other central banks, and that's exactly what we need to see for the Japanese equity market, we think.
Santara, thanks so much for joining us. Great conversation.
Thank you.
Right, BlackRock CEO Larry Fink says Japanese equities have more upside as well. That's his view, and we'll hear more of that on Mad Money with Jim Cramer tonight, 6 p.m. Eastern. Big interview that Jim has done with Larry Fink. Extensive. The biggest money manager, of course, in the world. Meantime, search and rescue efforts continue for survivors after a container ship struck a major bridge in Baltimore early this morning. As a result of the wreckage, all vessel traffic in and out of the port of Baltimore has been suspended until further notice. This video shows the moment a 948-foot vessel sailing under a Singaporean flag crashed into a pillar supporting the bridge before tumbling into the river. Dramatic images showing the scale of the collapse that we've been looking at all day. Eamon Javers is on the scene with the latest and what President Biden has been saying about the incident in the last couple of hours. Eamon?
73 counterparties take 400.
Well, Wilfred, to give you a sense of the scene right here, we just saw a few moments ago a giant flatbed truck full of floodlights pulling in. Clearly, they are setting up for some nighttime work here overnight. We're still many hours from darkness here, but plans moving ahead for that. And as you can see right behind me, they're just pulling up a couple of flatbed trucks with giant mobile offices on them. Those are being unloaded right now. You can see in your picture there. Those just arrived a few moments ago. So clearly, officials here settling in for the long haul in terms of the recovery effort and the reconstruction effort that is to come. You see behind me, that is the vessel that struck the ship. You can see it's still packed high with those containers on the deck of the ship. The ship itself is wedged under the wreckage of the bridge, right where the bridge collapsed, and that one piece of bridge wreckage still propped up on the bow of the vessel itself. That ship has not moved since about 1:30 this morning when it impacted the bridge. As of now, this is still a search and recovery effort. They said there are divers in the water. We've seen Coast Guard helicopters circling overhead, and there's some question now about the remaining 6 individuals who are still unaccounted for at this point. We know that 2 were in fact rescued, but it has been a long time since this impact and a long time since somebody was rescued here at the scene, Wilford. The president speaking in the Roosevelt Room a short time ago, talking about that recovery and talking about what his plans are for the future now. Take a listen.
I told them we're going to send all the federal resources they need as we respond to this emergency. And I mean all the federal resources. And we're going to rebuild that port together. Everything so far indicates that this was a terrible accident. At this time, we have no other indication, no other reason to believe there's any intentional act here.
So the president also saying there that the federal government will pick up the tab, whatever it might be, for reconstruction of this bridge. Obviously, a vital artery in terms of traffic and commerce and leisure travel here on the eastern seaboard of the United States. The president was also asked, though, if the federal government is picking up the tab here, what about the shipping company that was a private company that was apparently responsible for this accident? The president said, we're simply not going to wait to adjudicate all of the liability here. We're going to get moving on a rebuild. The federal government will pick up the tab, and if there is any liability, that clearly will come on the back end. It'll be the taxpayers first paying for this before any resolution of the liability issues here. As you can imagine, those will be presumably epic. Wilfred, back over to you.
Eamon, great stuff as always. Thanks so much for that. We want to draw your attention to shares of International Paper. They're moving lower in the last few minutes as the company reportedly puts in a bid for London-based rival DS Smith. That's according to our colleagues at Sky News. Mark Kleiman reporting that. The bid could throw a wrench into DS Smith's ongoing potential merger with Mondi. As you can see, it just slipped about 0.5%. It slipped a bit more than that initially, got down to about $39.50, but recovered $1 or so since, down, 0.75%. Well, coming up, UPS holding its Investor Day today with the stock coming off a second straight year of losses for the first time since the financial crisis. Well, our CEO, Carol Tomé, what it'll take to turn things around. That's coming up next. Plus, here's another look at today's mystery chart with shares down 30% from their recent high. It's one of the worst consumer staples over the past year, but our market guest coming up later in the show says now is the time to buy. The Exchange back after this short break.
This is The Exchange on CNBC.